Good afternoon. Welcome to NYFP. Today we'll be taking a closer look at earnings in terms of performance as well as what we can expect going forward. Joining me now is Brian Barnier of ValueBridge Advisors. Good afternoon, Brian. Thanks for joining me today.
Glad to be here.
Well, the earnings season is done, and we will continue to focus on growth here in the U.S. as well as overseas. But in terms of company performance, what have we been seeing so far?
So what we've seen, the big number we're looking for, of course, is revenue. Top line, how are they doing? Because that's much less difficult to manipulate, first of all, but second of all, it's more reflective of the real economy. So we look at quarter over quarter, first quarter over first quarter last year, and then compare that to what happened last time, fourth quarter over fourth quarter. Things have gotten worse. So previously, we had about 1.5 decreases for every one increase. This time we had just under 1.7 revenue growth rate decreases for every increase.
And in terms of share prices versus revenue, what are we seeing right now?
Well, we're still seeing a market that is a little on the pricey side. Now, if you're looking at it by earnings, everybody's saying it's a cheap market. But when you're looking at it by real revenues, top line that matters, we're in a category now that's gone up quite a bit from our low, and we're back where we were at the early 2000s or before the dot-com bubble burst. There they had a lot more reason to expect growth to come in. Now our macroeconomic picture is far more cloudy, and that's why some of us are worried.
And Brian, we're here at the beginning of June, and we will be kicking off the new quarter pretty soon. So we do pay attention to analyst forecasts, but prior to our interview, you mentioned that we're seeing excessive exuberance in terms of earnings forecasts out from analysts. What exactly do you mean?
Well, we all know that the sell-side analysts, like so many people you see interviewed from down here, are a little bit on the high side. And I've just been asking friends on the floor here, how high do you think they are? You know, 5%, 10%, some people say 20%. And as one friend said, you're smiling, is the real number higher? And I said, yes, the number is much higher in many cases, sometimes going over 50% when we look at 2013, 14, and 15 forecasts compared to my friends, the economists, and where their median forecasts are for growth. So that should suggest a lot of caution on the part of people that are watching all these interviews out here, and also the need to really get our heads wrapped around how we're understanding our financial information and the risk that's in this marketplace.
And you bring up a lot of important points there, Brian, and we're here on Jobs Friday. So we know where the market stands, and we get a better understanding of where the Fed might go in the near term. But what do you think investors should also keep in mind?
Well, if we're looking at the jobs issue, it's really the structural quality of the jobs that are out there. And that's when we look at these reports and we look at sectors that there's a lot of growth in, say construction and retail, hospitality, healthcare. The thing is, a lot of those workers are now not just part-time, but are contract workers, less benefits, much less stability. That's not good for people trying to get credit in mortgage applications, and we see that showing up in the housing numbers. So all these kinds of structural things are the reason to give people pause, and the reason to look for some very specific types of good information, such as those real wage, W-2 jobs with solid prospects in good industries.
Okay, Brian, well, thank you so much for your insight today, and thanks for weighing in on earnings.
Glad to be here.